Now let's talk about Chapter 8, Long-Term Assets. By definition, whenever you hear the term long-term, what we're talking about is a time period of greater than a year or an operating cycle. Where we talked about in prior chapters of current assets, which were assets that we were going to use or take advantage of in 1 year or less, these are the assets that we're going to use in more than a year, or that we're going to get benefit of the use of these assets for more than a year. Because of that, we do not expense the acquisition of these assets. What we want to do is we want to capitalize the asset costs into what it costs us to purchase and acquire and get this asset into its usable condition. Then we take those total costs, which could include the purchase price, installation, freight, insurance, and all those other costs, add them all up, and then we're going to allocate them over what we call the useful life of the asset. We allocate the useful life of the asset so that we can show that this asset has a benefit period of greater than a year. We call that depreciation. Now, the depreciation is normally for assets that we call property, plant, and equipment. Property, plant, and equipment is a category of long-term assets that are basically the assets that are used for the day-to-day operations of our business and that they're tangible in nature. Now, there could be other assets such as natural resources, and when you hear the term natural resources, we're talking things like coal, gas, and oil, and other resources that we take out of the ground, but we use that as part of our production process or our day-to-day operations. So, when we use up our natural resources, we end up depleting our assets. Now, the last type of long-term asset is called an intangible asset. And by what we talk about intangible assets is that it's used for the day-to-day operations of our business, but an intangible asset does not have any texture or feel to it. It's a protection of a right, or the ability to protect a company so that they can recover their investment. So when we use up an intangible asset, we end up doing what we call amortization. Now, in either case of these three, depreciation, depletion, or amortization, as we accumulate the spreading of the cost over the life of the asset, we are going to increase a contra asset account called accumulated depreciation. So what should happen on our balance sheet, we should have an asset account such as equipment less accumulated depreciation. Okay? So equipment, which is property, plant, and equipment, would be the name of our asset, our long-term asset. We subtract out our accumulated depreciation, which is all the depreciation that we've taken on this particular asset as we've owned that asset. So for instance, if I have $100,000 in equipment, and over the years so far I've depreciated $50,000 worth of that equipment, when I take the difference between the $100,000 and the $50,000, what I'm going to come up with is $50,000, which is 100 minus 50 gives me 50. This difference is called the book value. And what the book value is the value of the asset at that particular point in time. Now, this becomes a significant issue because a lot of times when you look at a balance sheet, someone might say, I have $1 million worth of equipment. The key number here is the book value, because what happens is someone might have $100,000 or $1 million, but if they've had that equipment for a long period of time and they've been depreciating that asset so that pretty much it's worthless, the book value is going to be very low. So if that's very low, it kind of tells you that it's time to replace the equipment. And so even though you might have $100,000 worth of equipment, it really isn't worth anything. The other important thing is that this book value, when we go to depreciate, becomes an important factor when we're looking at the value of our asset. Because as we depreciate the asset, or deplete the asset, or amortize the asset, we can only depreciate, deplete, or amortize up to the point where the book value equals what we call the salvage value. Now, the salvage value is what we think the asset is going to be worth at the end of its useful life. Okay, so now what I've done is I've given you three terms. I've given you the term asset cost, the cost of the asset, and when we talk about the cost of asset, once again, by definition, is all the expenditures made for the acquisition of the asset, which includes the purchase price, installation, freight, insurance, testing, special setup, electrical, everything that comes to get that asset into its operating condition. The second one is what we call the useful life. And when we talk about the useful life, is how much or how long do we think this asset is going to last? Sometimes that might be expressed in years. Sometimes it might be expressed in capacity in terms of number of units that it is capable to produce. It could be based upon hours and how long does an asset be able to run. Then finally, the last one is what we call the salvage value. Now, the salvage value, also known as the residual value, those two terms are the same. Salvage value and residual value basically says how much is this asset going to be worth at the end of the useful life of the asset. So as we go depreciate this asset, when we have to stop depreciating when the salvage value equals the book value. Now, probably the best way to illustrate this is by going into some problems. So let's go ahead and take a look at some problems with different variations in determining cost, allocation of cost in a lump sum purchase, and also the times when we're going to take an asset and then we're going to use it for its and determine all the costs for its intended use. So let's go ahead and take a look at some of the problems, and hopefully that'll answer all your questions. Our first problem that we want to talk about here is to determine the cost of a plant asset. Now remember, a plant asset is tangible in nature, so we're calling this property, plant, and equipment. Property, plant, and equipment assets are depreciated over its useful life, and what we first have to do before you can ever do any depreciation is we have to determine what the cost of the asset is. So let's take a look at this problem where it basically says Rizzo Company purchases a machine for $12,500 with the terms 210 net 60 FOB shipping point. Now what that is telling us is that when they purchase this asset for $12,500, if they were to pay this invoice within 10 days of the invoice date, the vendor is willing to give them a 2% discount. If they pay this invoice after the 10th day, the entire $12,500 is due in total after by 60 days. Now the FOB shipping point, if you remember in prior chapters, FOB, or free on board, shipping point means that the ownership of the asset changes hands at the time of shipment. It also means that the buyer has to pay for the freight charges. So now when we look at the next sentence here, it says the seller prepays the $360 of freight charges, adding the amount to the invoice to bring the total of the invoice to $12,860. The machine requires special steel mounting and power connections costing $895. Now remember what we just previously said about what makes up the cost of an asset. the purchase price, and in this case it's the $12,500 plus all the additional costs that it takes to make up or to make this asset in a usable condition. So that also includes the freight that we have to pay of the $360. But now look at this $895. This $895 is for special steel mounting and power connections, because without that steel mounting and power connections, we wouldn't be able to use this asset. So this cost of $895 is related to getting this asset into a usable condition. Now it says that another $475 is paid to assemble the machine and getting it into operation. The key thing here is that because of the assembly, it's getting it into its usable condition or into operations, so we also want to include the $475. Unfortunately here it says in moving the machine to its steel mounting, they incur damages of $180. Now the problem with this is the question is whether you include or not include this $180 into the cost of the asset. If this product needs to be repaired, if you purchased the machine and it was broken at the time it was purchased, and you have to spend this $180 to make it into its usable condition, this $180 has to be included into the cost of the asset. But if the asset was in good condition when you purchased it, and it so happened to be broken after you owned it, the FOB shipping point, and you're just repairing the product, the $180 does not get included into the cost because it's actually a repair to the product, not a part of the cost of the installation. Then finally the last one says also the $40 materials is used in adjusting the machine to produce a satisfactory product. So in other words, those adjustment costs are also part of getting this machine into a usable condition. So in order to determine the costs that go into making the cost of the product, what we have to do is we first take a look at the invoice price. And the invoice price was $12,500. But we took a 2% discount because here in this part it says they went ahead and took the 2% discount. So less the discount. Now the discount was the $12,500 times 0.02 or 2%. So we're going to take a $250 discount. So what gives us then is our net purchase price, and our net purchase price is essentially our $12,500 minus the $250. So the net purchase price of this piece of equipment was $12,250. But we're not done yet because once again we have to add in all these other costs that are associated with getting this equipment into a usable condition. So we want to include the freight, and the freight charges were $360. We also want to include the mounting and the power connections. And that came into, let's see, $895. We also want to do the assembly. And the assembly cost was $475. And then finally we want to do the materials used in adjusting. And that is in the amount of $40. Notice the only thing we did not include is the $180 in damages that occurred during the installation. Because when we purchased this equipment, it was in usable condition, it worked, we broke it at the time of installation. So therefore we do not include this $180 because it's a repair. So what we can do is now we can come up and we can say the total cost of the asset and what it is it's all of the costs, the purchase price, all the way through the materials used in adjusting. So it gives us that our total cost to be recorded for the purchase of this asset is $14,020. All right? So that's how you determine the cost of the asset. Once again, definition-wise, the definition was the purchase price plus all the additional costs to get the equipment into a usable condition to give you what the total cost of the asset is. Okay? So let's go to the next question, which I think has to do with the allocation of costs when you buy multiple items within the purchase. So let's take a look. This next problem has to do with, once again, determining the cost of an asset. However, we're changing this a little bit because now instead of purchasing a piece of machinery, now we're purchasing a piece of land and what we're going to do to intend on building onto that land. And what this says is Calla Manufacturing purchases a large lot on which an old building is located as part of its plans to build a new plant. The negotiated purchase price is $280,000 for the lot plus $110,000 for the old building. The company pays $33,500 to tear down the old building and $47,000 to landscape the lot. It also pays a total of $1,540,000 in construction costs. This amount consists of $1,452,200 for the new building and $87,800 for lighting, paving, and parking area next to the building. And what they want you to do is to prepare a single journal entry to record these costs incurred by Calla, all of which are paid in cash. So what we have to do is that we have to determine the cost of the land. We have to determine the cost of the building. And the land improvements. Okay, those are the two things we have to do. So now if we look at here, the negotiated purchase price is $280,000 for the lot. So the cost of the lot was $280,000. Now, what do we do with this $110,000 for the old building? Now, if we were going to use the old building, the $110,000 for the old building would have been a cost for the building. However, because our plans are to tear this building down, this building actually is not, its intended use is not the old building, but we have to prepare the lot so that it can be used for what its intended use, which is to build a new plant. So this $110,000 that's being purchased for the old building is actually a cost of the land because we had to buy the building in order to get the land ready for production or to construction for the new plant. So in this case, this $110,000 has to be included in the cost of the land. So we purchased the old building for $110,000. Then we look at here, the company pays $33,500 to tear down this old building. So the demolition cost is part of the cost of the land to be prepared because we have to get rid of the building. So let's take the $33,500 and include that into the cost of the land. Next, as we look at it, is there any other costs? As we look in here, it shows that they paid $33,000 to tear it down, $47,000 to landscape the lot or to prepare the lot for construction. So basically, these are all the costs to get the land into its usable condition. So my total land cost is the $280,000 plus the $110,000 plus the $33,500 plus the $47,000. So our total land cost comes up to $470,500. The other additional costs are the cost of building a new building. So the cost of the new building, as they tell us here, is $1,540,000. However, it's not total because they broke it up as $142,200 and $87,800. So it's not $1,540,000, it's $1,452,200. The land improvements, which was the $87,800. Now remember, what is land improvements? Those are the things that we do to the land to make it better, like lighting, parking lots, planting shrubbery, and all that other stuff. So that gives us the total cost for the new building and land improvements. So if we add these two together, we get the $1,540,000. So now, what would the journal entry be? We need to recognize the purchase of the land, the construction of the building, construction of the land improvements, and that we paid out cash. So our journal entry would be debit land, and the land debit would be for $470,500. Debit building, and that building is going to be the $1,452,200. Debit land improvements, and that's going to be the $87,800. And we're going to credit cash because it says we paid all cash for it. So if I added up the $470,000, the $1,452,000, and the $87,000, we're going to come up with, well, let's add it up and make it easier. $2,010,500. So this is your journal entry that you would be needing to make in order to record the acquisition of that land and the construction of the building. Okay? So let's go move on to the next problem. Once you've determined the cost of an asset, the next thing you have to do is determine depreciation as you use the asset over its useful life. Now, in our textbook, what we're talking about are three different methods in which you can select to use to compute depreciation. So here, in this particular example, we're going to do the three requirements of straight line depreciation, units of production depreciation, or double declining balance depreciation. Now, before we do that, let's get some formulas straight. For straight line depreciation, the formula is take the cost minus the salvage value divided by the useful life. Okay, so if I take my cost, and if I look at this problem, it says Ramirez Company installs a computerized manufacturing machine in its factory at the beginning of the year at a cost of $43,500. The machine's useful life is 10 years or 385,000 units of product with a $5,000 salvage value. So during the second year, the machine produces 32,500 units of product. Now, the thing with straight line depreciation is once you determine what the depreciation is for 1 year, it's the same amount of depreciation for the entire useful life of the asset. So if that's the case, if I want to compute a formula, I could say take my salvage value, which is the $43,500, minus the salvage value of $5,000, divided by the useful life of 10 years. So my formula would look like this. And by doing so, the total, or my depreciation for every year during its useful life, is going to be $3,850. So regardless of whether it's the first or the second year, it's the same dollar amount. Now the second method to computing depreciation here is called the units of production. Now with the units of production of depreciation, it takes 2 steps. So first of all, step 1 is compute the unit rate. So what we mean by the unit rate is how much can you allocate of the cost per unit of what is estimated. So what we have here is a formula. It says take the cost minus the salvage value divided by the estimated number of units. Okay, so what we can do here, let's say step 1, we could create a formula that says take my cost, which is the $43,500, minus the salvage value of $5,000, divided by the estimated number of units, which was 385,000 units. And what I get is that it'll basically cost us 10 cents per unit. Now, next, we have to take step 2, which is multiply the unit rate times the usage. So in step 2 here, I would take my unit rate of 10 cents per unit times the number of units we produce, and at the very last sentence it says right up here, during its second year, machine produces 32,500 units. So I'm going to put 32,500. So my second year depreciation would be $32,500. Or $3,250, sorry, because what I've done is I've taken my 10 cents times the 32,500 units produced. Now the last method that we need to compute is the double declining balance method. Now the double declining balance method is an accelerated depreciation method, and when we mean double is that it's almost twice as much as the straight line method. Now the thing with accelerated depreciation is that we're going to use up the asset in terms of depreciation faster in the earlier years than in the later years. Now, when we compute the double declining balance method, it takes 3 steps. So step 1 is to compute the straight line rate. Okay, so if we have the straight line rate, we basically have is that we have 10 years. So what we could do is we could say basically take 1 divided by 10 years. Okay, so if I do a formula here and say 1 divided by 10, I'm going to get 10%. Okay, so my straight line rate is going to be 10% per year. But now in step 2 is multiply the straight line rate times 2. So that's because it's going to be double declining. So I want to take the 0.1 or the 10% times 2 to give me basically a 20% rate on the double declining balance. Now, notice so far in our calculations here, we have not taken into account salvage value. The double declining balance method, or the declining balance method in general, does not take into account salvage value. Because it is an accelerated depreciation method, it wants to accelerate as fast as possible. So what you have to do as the computer of the depreciation is you have to be recognizing that there's going to be a point when the book value and the salvage value are going to equal. When this book value and the salvage value equal, that's when you're supposed to stop taking any additional depreciation. Now that could actually happen in the middle of a year. So if that's the case, what you have to do is in the last year or the year where you think you're getting close to the book value equaling the salvage value, you want to keep an eye on that because the most depreciation you can take is when you get the two to equal. So now, in order to get each year's depreciation, we want to do step 3, which is multiply the double declining balance rate times the beginning book balance or book value for the year. So let's take a look at this problem here. If I know that my purchase price is $43,500, that's my ending book value, or my starting point. So let's put that right here. Okay? Now, if the ending book value in 1 year is the beginning book value in the next year, so we're going to put the $43,500 there. Now, in step 3, it says multiply the double declining balance rate against the beginning book value. My double declining balance rate was 20%, so what I'm going to do then is I'm going to take the $43,500 times 20%, or 0.2, to give me depreciation in the first year of $8,700. Because this is the first year, my accumulated depreciation is also going to be $8,700. So if I've got depreciation, that's going to reduce my book value. So my ending book value is going to be the $43,500 minus this year's depreciation. So my ending book value is going to be $34,800. Now the $34,800 of my ending book value is going to become the beginning book value in the next year. So once again, at $34,800, I'm going to take that, my beginning book value, times my double declining balance rate of 20%. I'm going to get depreciation of $6,960 in the second year, which then would increase my accumulated depreciation to $15,660, or my ending book value, which is my beginning book value minus the current year's depreciation, to give me my beginning book value of $27,840. Now this problem was asking what is the second year's depreciation. The second year depreciation is the $6,960. So in future years, in year 3, I can look here and that the $27,840 with a salvage value of $5,000, I still have $22,840 worth of cost that I can allocate to this depreciation for this asset. Once my $5,000 equals my book value, my salvage equals my book value, it's time to stop taking depreciation. So those are the three methods of depreciation. Straight line, the same dollar amount every year. Units of production, based upon the amount of production or usage of that asset in the year of the depreciation, based upon a stated rate. And then the accumulated depreciation method, or the accelerated depreciation method called double declining balance, which is an accelerated method based upon the double of the straight line rate. All right, so let's take a look at the next problem. Now, as we've been computing depreciation, remember what we've said. The three items that we needed to, the items we need to compute depreciation are 1, the cost of the asset, 2, the salvage value, and 3, the useful life. Now, of these three items, the only one that we can prove 100% is the cost of the asset. We can produce invoices, canceled checks, or any other information to determine what the cost of the asset actually is. These other two, the salvage value and the useful life, are estimates. And being an estimate, there are times when the estimate may not be correct. So one of the things that we have to keep in mind is that things can change. Now, if you should decide that you're going to change your depreciation amount because either the salvage value or the useful life changes, or the other side of it too is that we've added to the cost of the asset, we do not go back and correct our depreciation, but rather what we do is we take the book value at the time of the change in estimate and then recompute our depreciation going forward. So let's take a look at this problem. It says Apex Fitness Club uses a straight line depreciation for a machine costing $23,860 with an estimated 4-year life and a $2,400 salvage value. At the end of the 3rd year, Apex determines that the machine has 3 more years of useful life. So we're changing the useful life, after which it'll have an estimate $2,000 salvage value. So first of all, they want you to compute the machine's book value at the end of the 2nd year, and 2, the amount of depreciation for each of the next 3 years. Okay, so first of all, what you have to do is compute what was the depreciation at the end of the book value at the end of the 2nd year. They use straight line depreciation. So we start with the original cost. So we start with the original cost of the asset, which was $23,860. Less 2 years worth of depreciation using straight line. Okay, so how did we compute that depreciation? We said the formula, was cost minus salvage value divided by the useful life to get the straight line depreciation. And we did it for 2 years. So what we're going to basically say here is take the $23,860 minus the salvage value of $2,400 divided by 4 years, and then we're going to multiply that times 2 for the 2 years. So let's make that formula over here. We can say 23,860. Oops, let me put some parentheses here. We'll say 23,860 860 minus 2400 divided by 4 times 2. So we've got that we've depreciated over 2 years $10,730. So that gives us the book value at the end of the second year. So what we want to do is take our purchase price minus our accumulated depreciation to give us a book value of $13,130. Now, what we want to do is we have to determine what's the depreciation for the next 3 years. We said when we change our estimate, we have to go and recompute our depreciation based upon the book value at the time of the change. So this book value of $13,130 is our new book value at the time that now we're going to change our estimate. So if we're still doing straight line, we can figure out how much we're going to use to depreciate. So our new salvage value is $2,000. So we're going to say less the new salvage value, which is $2,000. So that gives us our remaining depreciable asset, or depreciable cost, which basically means that this is what we're going to be allowed to use to depreciate. So it's $13,130 minus $2,000. So I can now depreciate $11,130. So now the straight line depreciation again. The revised depreciation is going to be the $11,130, which is the book value minus the new salvage value, divided by the new or the remaining useful life, which is going to be 3 years. How did we get to 3 years? Because what they said here is that they're going to give us 3 more years remaining in its useful life. So the new depreciation for the next 3 years, because it's straight line, is $3,710. Okay? So that's how you have to do to figure these out. Okay, we have one more problem to do, so let's move on to the next problem. Our last problem that we're about to do here has multiple components. First of all, the 2 components we're looking at is one is the determination of cost when you buy multiple items in the single purchase price. The second thing that you have to calculate with that is that where do you allocate the cost to various products? So let's read this problem. The first part of this problem says, in January of 2008, Mitsu Company pays $2,600,000 for a tract of land with 2 buildings on it. It plans to demolish building number 1 and build a new store in its place. Building 2 will be a company office. So of these building 1 and building 2, building 1 is going away, and it's not going to be used. So its intended purpose for building 1 is to be a piece of land. Building 2 is going to be used. And then it says that it's appraised at $644,000 with a useful life of 20 years and $60,000 salvage value. There's a lighted parking lot near Building 1 with improvements valued at $420,000 and are expected at least another 12 years with no salvage value. Without the building and improvements, the tract of land is valued or appraised at $1,736,000. Mitsu also incurs additional costs for demolishing the building, to grading the land, constructing a new building, and then also the cost of new land improvements. Now, what I'm going to do with you here is just doing the allocation. We've gone through enough problems now to compute the depreciation once you determine the cost. So what I'm going to try to do here is to kind of go through with you, how do we come up with this allocation? The very first thing we have to do is allocate the purchase price. The purchase price is $2,600,000. And unfortunately, though, if you look at the appraised value and add them all up, those appraised values are greater than the purchase price. Now, what we've talked about in the lecture online, we talked about that when you buy something, a bulk purchase, you need to allocate the purchase price amongst all the items that are going to be used. And we normally use the appraised value of those items in order to determine what the cost is going to be. So if we look at here, we had the land that we're purchasing. Now, building 1 is going to be demolished. And so building 1 is actually going to be part of the cost of the land, because that's what the whole intent was, is to knock it down so we can build something else on top of it. So building 1 has no cost. Building 2 needs to be included because we're going to use it for normal operations as an office. Also, we're going to come up that we look there is that we also have land improvements. And we'll call that land improvements number 1. So what we have is the appraised values. And if we look up here, it says the appraised value for the land is $1,736,000. So $1,736,000. The building 2's appraisal, if we look up here, is $644,000. The land improvements is, if we look up here, is $420,000. So that gives us a total appraised value. We add these all up. Of $2,008,000. So notice the appraised value is $2,008,000, but we only paid $2,006,000. So by definition, when we do an allocation, we're going to allocate based upon the relative market value. The appraised value is the market value. So what we have to do is come up with a percentage to make our allocation. So what we want to do is we want to say the percent of total, the percent sign. Let's got to get the right place here. Percent of total. So if I take the $1,736,000 divided by the total over here, we're going to get 62%. I can do the same thing with building 2, the $644,000 divided by the total to give me 23%, and then I can take the $420,000 divided by the total, and I get 15%. So if I was to add all 3 percentages, I should come up with 100% or 1. Okay, now that I know what this is my allocation percentages for my purchase price, I can now say my purchase price of $2,600,000, and it's the same amount for all of them. I'm going to multiply my purchase price times the percentage. So what I've done is I multiplied my purchase price of $2,006,000 times the allocation percentage to give out how much is my apportionment cost. Okay, and so we can test this. Let's make sure that it equals $2,006,000. Add them up, and there I go with my $2,006,000. So now that I have my $2,006,000, I know what each of the components are for the land, building 2, and land improvement 1 in order to determine what my acquisition costs. So what I can do is I can actually go here and allocate all the costs into my purchase. So first of all, let's do some titles here. I know I've purchased land. I purchased building 1, or building 2, sorry, because building 1 got knocked down. I also are going to construct a new building called building 3. I'm going to have land improvement 1, which is in the original purchase, and then land improvement 2, which is what I'm going to construct. Okay, so now we can take this one at a time, and we can say, first of all, let's take the purchase, and we did the allocation of the purchase. So I've got $1,612,000 to the land. I've got $598,000 to the building 2, and I've got $390,000 to land improvement number 1. Just to prove that this is correct, let's put a total here, and I can say, let's take the addition of all these cells. I get my $2,000,006. Okay? Next, we can go through all the lists of here what we have. So the cost to demolish building 1, cost to demolish building number 1 is, as it shows us here, is $328,400. And we said, because that building was intended to be demolished anyways, it's going to be part of the cost of the land. Then we have to look here, and also that they said they're going to grade the land, so the land grading, which is flattening out the land so we can do the construction. Land grading was $175,400. Okay, and then any additional costs, the construction cost, we'll call it construction cost for building 3. And according to this, the cost of building 3 was $2,202,000. And finally, the last one is the cost of new land improvements, which we're going to call land improvement 2. So construction cost for land improvement 2 over here is $164,000. So now I can take my totals here just to make sure we're right. And so I have my totals. So now what I can do is I can say how much do I have in land, so I can say my totals. My land cost are all these costs here. My building cost, my building 3 cost, my land improvement cost, and all my costs here. So now I could do my journal entry, debit land, debit building, debit the 3rd building, debit land improvement 1, debit land improvement 2, credit cash, because we have said we're going to pay cash. So this is how we would do the allocation for this problem. So you can do the journal entries, debit, 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 and credit. Part 3 of this problem wants you to do the depreciation. Now that you have the cost of building 2, 3, the land improvement, and land improvement 1 and 2, take a look at this problem up here to determine how much the depreciation is. I think because it's straight line, it's pretty easy because we've done it in a couple other problems here. So I'm going to wish you luck here, and we'll see you in the next chapter.